how the Fed really broke housing. I want you to focus on banking and the Federal Reserve. And just think about this for a second. It's 1999. It's a good year. It's the late 90s. Fed's fund rate, 4.75. Okay, sounds pretty high. That's basically what it is today. 2000, Fed's fund rate peaks at 6.5. Why? They were trying to cool down the tech bubble. So I graduated high school in 1996. My dad and I sat down at our gateway computer, the little cow print, sat there and said, how are we going to get rich buying tech stocks? And in the late 90s, I think he spent like 10 or 20. And we both just made these bets. And then all of a sudden, we're like, oh my goodness, we're making a ton of money on this. And then the tech bubble popped. Well, why did the tech bubble actually pop? The tech bubble popped because the Fed raised rates so high. See, the Fed's the master manipulator hiding in the background. .com crash, oh my goodness. And then we have the horrific events of 9/11. So the Fed then lowers the Fed funds rate from 6.5 to 1.75, and they basically remain low. 1.25, 2.25 in 2004. And then the Fed started raising rates again in 2004 because they said the economy's heating up. They continue hiking in 2005, 4.25. Uh-oh, here it comes. 2006, the Fed fund rate reaches 5.25, where it remains until the summer of 2027. So did housing pop, or did the Fed cause housing to pop? They're just pontificating on this, but I don't think they meant for the great financial crisis to become the contagion, the outbreak, and take out the world. But realize the Federal Reserve did this.
What is the Federal Reserve rate right now?
5.
So they're basically backing off before any crash is about to happen. So wouldn't you say that what Papa Powell is doing is the right thing?
Oh my goodness. Bro, he just backed me into a corner. On camera, I'm backed into a corner.
Based off of what you're saying. Shouldn't we just drop them now before this happens?
Let's look at this from a couple different angles. So one, that was an amazingly powerful question. I give you mad props. 2, it would appear Papa Powell is doing the right thing and headed towards the soft landing because labor appears to be breaking. And if you break labor, our whole economy breaks. So you have to slow down the tension by easing monetary policy before labor breaks. Because if labor breaks, and here's what I mean by that, if unemployment rises drastically, then the economy goes down the tube, because that's what you saw in the great financial crisis. So theoretically, they are doing the right thing and getting ahead of this. Will Papa Powell be able to stick the soft landing? Don't know. Are we going to have a no landing? Don't know. Are we going into a mild recession? Don't know. But I don't think we're going into a super hard recession. And I don't think we're going into the great financial crisis. And it looks like home prices are not going to massively crash because they didn't already crash during the massive drop in transactions and the highest rates since the 1980s. If they would have crashed, it would have already crashed because they came down in 2022 and they've started rising again, and now they're lowering debt. Real estate went through a transaction recession. Now we're getting ready to go back into price rising. This is that rolling recession we're talking about. We already got hit. Our time is over. So for our investors who are really paying attention, our savvy buyers, once again, this is your buy signal, not necessarily financial advice, but I'm spending my own money. This is your buy signal because the Fed's lowering rates. And if we look back through history, as the Fed lowers rates, real estate transactions pick up and prices increase. You look like you want to say something. What are you thinking?
I'm just thinking, okay, well then on the flip side, say they didn't lower rates. Say they kept them the same or maybe even up them even more, because technically we're not at the 2% inflation target of the Fed. Part of them raising rates is so that inflation gets back on track. Wouldn't you say there'd be less buyers and homes would just not sell?
If rates are over 7%, prices can decline. The Fed funds rate needs to be about 5.5% or higher for us to have rates over 7. As the Fed lowers rates and rates get in the mid sixes, which is where they are today, I believe you have price stabilization. As the Fed lowers rates and rates get towards the low sixes, you have slight increases. As rates get below 6% into the fives, you have an increase in prices, increase in price velocity, let's call it. As we enter the low fives, expect an unlock in inventory to start and to price velocity to increase even more. But let's give our listeners a golden nugget. Let's nerd out with them for a second. CPI just came out literally yesterday. It hit expectations to the high side, and all the news media comes out and says, inflation's running hot, core CPI is running hot, the world's going to hell in a go-kart. Come on, people, slow down. Read the data. Review what's happening. We've talked about this before. Go 3 layers deep, figure it out. Cool, you go and dig into it. What does it actually say? It's showing that housing in there, which makes up over 30%, almost 40% of the index, because it's looking at a 12-month run, is still running at about 5%, specifically rents. Anyone listening to this right now, do you know of anywhere rents going up in the US by 5%? And the answer is going to be no, because it's not. Because rents are flat and slightly declining and barely going up in some metros. The way inflation is calculated is an old metric where they take every month over 12 months. And so because of the trailing data, it's making CPI look hotter because you had a bigger boxcar full of more goods and services come through. So if we just went and looked at actual rents last month and backed it all the way out, what do you think inflation actually is today? Today's actual rate of inflation, if we take out the archaic way of looking at owner's equivalent rents and rents over 12 months, what's the actual real inflation today?
Maybe closer to 2.
Below 2%. Depending on how you measure it, it's literally like 1.6 to 1.8. We're at the freaking Fed's target.
But couldn't you say that it's like that because we got so high? It's like a balancing out.
Yes.
Because we're supposed to go 2%, 2%, 2%, 2%, 2%, 2%, but then we went like this. Just like we're stealing homeowners and home buyers from the future. Yep. We're basically stealing inflation from the future. And so even if it's going back down, it's just like a balancing out of that little hump.
This is where people get this confused. Inflation is the rate of change of prices. It doesn't affect the actual price. So it's just a slowdown of the gain. Prices are still freaking high. Everything's still super expensive. What it's saying is price growth is slowing down. Mm-hmm. The main thing I want people to hear, though, is that inflation is already below 2%. So Papa Powell's making the right move, which means home prices are headed in an upward direction based on history.